All right, so getting started investing, we've got it down to 3 steps, and we're definitely going to be delivering this. But before we do, I hope I'm not delaying too much the gratification of this podcast, but I do feel like we should talk briefly about volatility and market drops. So whether you're invested in stocks or whether you own stock funds, equity funds, if you will, David Kretzmann,
right.
You need to realize that 1 year in 3, historically, the market drops. And for a lot of people, psychologists tell us the pain of loss is greater than the joy of gain. And sometimes if somebody starts and their first year of investing was one of those 1 in 3 years where the market drops, they might have a really bad taste in their mouth, stop funding their account, decide this wasn't for them, and stop investing. And we all know what a horrible mistake that would be. But gentlemen, any thoughts about just market volatility, drops, and how that affects us with that lifelong odyssey of investing?
Yeah, I'll just chime in. I think this is why investing in your retirement account, whether that's a 401k through your employer or a self-directed IRA, is so important. Because if you're doing that, ideally with an employer, you're having a little bit of your money taken out of your paycheck every pay period. Normally that's every 2 weeks or a couple times a month.
Trying to max that out, right?
It's
Jason?
max it out.
Yeah, maybe it's getting matched.
Exactly. It's free money. But really, I think even more valuable is that you're just going on with life, and that's happening every pay period, year in and year out. Market up, market down. It really helps you cope with that volatility, because at the end of the day, we teach people this. It's actually, as when you're a net buyer of stocks, you kind of like seeing that stock market pull back because you're getting a little more bang for your buck. And when you're looking at it in 10 and 20-year time frames, it really can start to add up.
Yeah, to add to that, money is so emotional for us, and it's emotional in ways that we don't even realize. And so when you see the market drop, it's hard to hang on, and it's hard to buy more. Just the actual way that our brains work, they work against us in those instances. It's interesting. Vanguard put out a study earlier this year, and it was quoted in Bloomberg, that shows that young adults who have started investing since the financial crisis are much more conservative than the experts would suggest for them to be. That 4 million accounts Vanguard has of people who'd already begun investing, they were twice as likely to hold no stock in those accounts as those who had begun investing before the crisis.
Wow. And this is not just a survey or something like that, Matt. This is real data from Vanguard looking over the accounts of 4 million account holders and what they're doing.
Yeah, and so going back to what we said earlier about time horizon, these are folks who have accounts and they're young. So this is a great time for them to get started buying stocks. But they're a little gun shy, and it just kind of goes to show you, how emotional it can be and how market volatility can scare people off.
Yeah, I think that emotional piece for most people is probably the most challenging aspect of being a successful investor. I think most people, even people on the street, they can recognize a good company. They can look at Apple and Starbucks or Netflix and recognize those are great brands, solid companies. They're becoming more relevant. The tricky part, though, is being able to buy and hold those companies through thick and thin, through periods like the Great Recession, or if an individual company is going through a tough quarter or year or two. So that's really, again, why it comes down to time horizon, whether it's individual companies or a fund like the S&P 500. The longer your time horizon, again, the higher the odds that you will come out ahead. And that's why anything you invest in the stock market should be money that you comfortably won't need for at least 3 years, and ideally much, much longer. Because if you can do that and have that mentality, start small with your investments, ideally add a little bit every month or quarter or year, whatever time frame works for people, then I think that helps ease the nerves that come with seeing that inevitable short-term volatility with the stock market.
Well put. Thank you very much. And let me close off this portion of the podcast by saying that we've tried to speak as helpfully as possible to you, whoever you are, especially if you're new at this. I'm quite sure we've probably missed something. We may have made some assumptions that were wrong assumptions, or maybe we just didn't give you enough. So that's why 1 month from this week, we're going to have part 2 to close off this short series for Rule Breaker Investing, Get Started Investing. We're going to have part 2. It's going to be driven by what you tell us. The email address is rbi@fool.com. We would love to hear any additional questions that we didn't speak to that seem important. We'd also love to hear some stories. Maybe you have a great story about how you got started investing. We'd especially love to hear that you got started investing from this podcast, that we helped you do that, because that's what we're trying to do this week. So again, 1 month from now, rbi@fool.com. Email us. Let us know what more we can program for a few weeks from today.